Today we're looking at whether the yen short trade has started to unwind since positioning has changed quite dramatically recently. And then we're looking at Goldman, back to Goldman's call for equities to end the year much, much higher. They've actually reversed it, so we're going to have a look at what they've been saying over there. And then the trading takeout today is going to be the easiest way to spot whether we're in a bull or a bear market. Now, before we get into today's video, I want you to click subscribe and like this video if you want more of this content to pop up to you every single day. It's important that you receive the message that I'm giving you every day if you want to maintain your trading edge. Now, you might have seen this chart before or heard of what this is before, and you might not have, but that's absolutely fine. I'm going to run through it very, very quickly with you, and it will cover all the main points so that you do get it. This is called the Commitment of Traders Report, and this is effectively a report of all the different positions in the futures market that are out there. So any positions that are via the CME, CBOE, etc., they're all aggregated into one place. And you can then view exactly how different participants in the market are positioned in a certain futures contract. So in front of us here, we have yen futures. So J6 is the currency ticker code for yen futures. And then what you can see here is the different types of participant in the market. So the red line is commercials, producers, merchants, processors, users, and swap dealers. Non-commercials in green are large speculators, managed money, hedge funds, etc. And then in blue are small speculators. So bear in mind that these are the net positioning, okay? And the way that futures markets work is that they are effectively trading. If you enter one contract long, one contract is short. Okay, so the aggregate position will always be neutral. However, some people are positioned in, different net ways versus others. So you can see here, and this is a drastic move, that recently the big players, the hedgers, have decided to cut their short positions as the large speculators have increased their long positions. So large speculators have been short for a very, very long time here, whereas the counter positions, the hedgers, have been long the market for a very long time, and it makes perfect sense because you have to be basically you have to effectively have a position against the same one, if you like. What we're seeing now is potentially a reversion. So the contract shorts have been cut from about 130K down to 105K, and that is just in 1 week. So there's been a lot of buying of yen over this period, and it gets reported obviously in a backwards fashion. So this tick up is from actually here, okay? So this is where the data starts to show that the buying has occurred. So it reports it for the week previous. Now, why might this be? Well, I'm thinking that it could be that because of the recent chatter around wage growth in Japan, that the Bank of Japan is having to be a little less loose with what they're talking about. So there's more unions that are having to speak with the Ministry of Finance to come to a deal, which could increase, the expected inflation rate for next year, which changes what the Bank of Japan can do, and the market is reacting. The market is therefore expecting yields to maybe tick up a little bit. And from that, it could expect them, because of the Bank of Japan's yield curve control, it could expect the Bank of Japan to have to act on that yield curve control. I'm not saying that it's going to increase interest rates, because they're so far down the line here with regards to being an easy monetary policy that it's not an easy thing to do for the Bank of Japan just to increase interest rates. What they're going to have to do is manage it bit by bit, literally baby steps, because a shock to the market could prove fatal, pretty much. So that's effectively what the Commitment of Traders report is showing. You tend to find that at extremes, the moves are very, very broad. So you can see that we've almost had, I think we have actually had a record net short position on yen. And now we're seeing a bit of a reversion. So it's very, very important to bear this in mind, because if we look at here, for example, when we previously had a low, okay, the market rallied for 6 months after that. And then it reverted again when we started to see the shorts come back in. Where else might there be a really good example of this? So key points, you know, here you can see that this ended up being a net high in positioning. And then the market started to come off, you know, until here, basically, where we saw that record net low again. We did see one here for a little bit where it just meandered. Nothing really happened. Again, these positions didn't really change a huge amount. And so, you know, what we're looking at here really is, okay, this could be a super bullish environment for the yen if this does get a considerable change in positioning. Someone pinged this to me today because I'd mentioned it on Twitter and I'd mentioned it to you guys as well. But Goldman have changed their call, specifically Scott Rubner, or Scott Rubner, I can't remember how to pronounce it, has changed his call on the melt up going into the end of year. And now he's saying instead, yes, we're there for the market to sell off. Yes, we have less than 5 trading sessions left of peak flow of fund demand for 2023. And then the pain trade moves to the downside, no longer the upside, which I can kind of agree with, actually. I'm so bullish that I'm turning tactically bearish. It's a very, very bizarre phrase. But he goes on to say that these are the 13 flow of funds points on why the market will be choppy, trade sideways, more ups and downs, and now is a fair fight. The positioning dynamic is now long and no longer a tailwind. Mission completed. Trade ideas below, given the pre-pandemic lowest. Okay, so he goes on to explain his 13 points below. I think this is from Zero Hedge, which is fine. But yeah, they kind of love anything doomy. But I think if we go back and look at the market, actually, we can maybe come to the same conclusion, because I had mentioned before as well. Let me just switch over to, I'm on the wrong tab, share this tab. So I'd mentioned, you know, running the linear regression. So the linear regression here in a previous video from last week or the week before was run from here up to this high. Okay, I can redraw that just to prove where it was from. So you can see there, it's from there to this high. And now what we're seeing is this 2 standard deviation move to the upside, which is, it tends to be where most data, I guess, accumulates itself, is a more objective way of drawing trend lines, basically. But you can see that if you draw this trend line, you know, it pretty much goes alongside it parallel, right? Now, whenever you see a move into that 2 standard deviation, it tends to kind of exhibit feelings of the move being done or the exhaustion being done. And so what we could look for here is, if we move this down onto the daily, is we can now start saying, okay, well, if we think this move is done, we're trading just above it now, where is a good target? There's the 200 daily moving average. I personally think this is just a massively position-led market. And I think as well, the way that it's looking is that it's doing a mean reversion consistently just within this channel. And I see it going very much like that until next year. You know, what we're going to see is probably the market trade very similar to this. You know, just up and down, just within this channel. It's going to be brutal, I think. I think it's going to be very brutal. I think earnings recession starts when we start ticking below here and we start to get down to below 3,800. That's when we start seeing that, you know, these tech giants no longer have sufficient earnings because people's wages are lower. And I think interest rate hikes, especially at the peak now, tend to take about 12 months to come to fruition. So we're going to see the effects of interest rates being at 5.5%, 5.25% now in 12 months, if that makes sense, which should have an effect on equities. But I kind of agree. Oh, let me just control Z that. I kind of agree with him in terms of where we are positioned in the S&P 500. I do think that it's time for some mean reversion, and this should be reflected in currency pairs as well. If we look at the Aussie, if we look at Aussie dollar, let's Go to the ICE one. Personally, I think this is how we trade. This was just a bit of a silly drawing. But I think we're at the 200 daily moving average now. We're at a resistance. Yesterday, I spoke about how currency pairs are related to risk and understanding what currency pairs are correlated to. And I think now, excuse me, what we are going to see is that risk dynamic re-enter. We're going to see currency pairs become very, very sensitive again to equities. And I like the Aussie dollar. If you're a fan of trading the Aussie, I think it's a great currency pair. There's a couple of levels here that I would identify from a risk to reward perspective as being relatively okay targets. So down here at spot 646, a nice support level if you would like to target that. You know, there's easily identifiable levels here. Let's actually draw this as a box. I always forget how to use this. There we go. Let's draw this as a box. You know, if you break below 200 daily moving average and this kind of support resistance level, probably a half decent opportunity there. Risk above some sort of volatility parameter. So if you want to even add in a shorter moving average, so let's do that now. Add in a simple moving average that is maybe a 20-day cross. This can be a perfect way to build a trading strategy, by the way. Maybe not 20 because we need it above. Let's go for a 50. See if that changes anything. No. So maybe we need 100 then. I'm basically looking for a moving average that is shorter than the 200. That is above the, we're still not getting it. Let's go for 150, see if that does anything. No, okay, well, maybe forget a moving average volatility strategy then. Maybe use something like average true range, or if you know how to calculate the daily or weekly expected return, you could look at that, which should probably leave a stop somewhere up here, giving you some form of, you know, above 1 risk to reward ratio. And that's all we're looking for. We're looking for probabilities just to be in our favor. We're not looking ever to be too scientific about this. We're not ever looking to be precise necessarily. Precision is a massive, massive downfall in trading. I see some people absolutely going bonkers over getting the perfect entry. And it's like, well, if you take maybe a 30 to 50 tick range, divide your positions up, or divide one core position up into 4, it lets you be more loose with where you're entering while keeping your risk nice and tight. So really, in my view, how people should want to be entering the market is more, you know, one position here, one position here, one position here, one position there. You know, hit here, take one off, take this position off, get back down here, take that position off, down there, that position, while moving your stop up. That's the way to do it. It's not advice, but it's a very good method to use. So yeah, I mean, that's where I see currencies becoming really correlated with equities now. I do agree with Goldman on this. I think he was right in his call in terms of equities melting up. He was very correct. However, it just happened very, very quickly. So he's now got to reverse it, which makes sense. So bear in mind that linear regression, 2 standard deviations is where we're at on the S&P 500. That tends to lead to some mean reversion, which should affect some currency pairs as well, such as the Aussie dollar, dollar CAD, potentially even the euro now as well. So how do we judge if a market is in a bull market or a bear market, or more importantly, what regime it might be changing to, whether it's going to turn bearish or bullish? Well, I'm going to give you some insight here as to how I like to identify short, mid, and longer term trends. In front of you, you have the percentage of stocks above the 20-day moving average in white, the percentage of stocks above the 50-day moving average in orange, and then the percent of stocks above the 200 daily moving average in blue, cyan, whatever color you want to denominate it as. What we're seeing at the moment is that we're actually at quite an extreme level for the 20-day moving average of stocks. You can see that back in July when we fell off, similar happened. Stocks, the 20-day moving average was up here at about 70+%. You can see that at the start of the year when we fell off as well, you know, we were up again, or this was 2022. We were up at here's the start of the year. Sorry, my apologies. We were up, above 70% again, actually extending all the way to almost 90%, which is pretty crazy. At the same time, concurrently, we had the 50-day and also the 200-day very, very high as well. Now, we're seeing a bit of a discrepancy here where the 200-day is very, very flat. And in my view, what we're seeing with that is to do with the Russell. So the Russell actually has lots of firms that aren't making any money in it. This is part of the predominantly the S&P 500, but as we know, Magnificent Seven make up 30% of the movement of the S&P 500 anyway. So interest rates are biting basically, which is, I think, keeping the percentage of the 200 daily moving average of stocks lower relative to history. But I think this is a bit of a bearish signal here. I think what we're looking at in the shorter term, at least, is, as I mentioned earlier today, stocks to start to get dampened. And this is a fantastic way that you can use to judge whereabouts we're at in the timeline.